panelists. I mean, I know one of them, Marcus, it's really early his time, so thank you for that. Just a little background about the Imagine webinar. At IvyCap, we created Imagine as a forum for discussion so that we could engage with business leaders, entrepreneurs, investors, thought leaders across the globe to help us, imagine, what's coming up in the future, be creative about, generating opportunities, and then also, being creative about solving the various challenges. And in our various editions in the past, our speakers have included investors, academicians, thought leaders, CXOs, and who've been helping us navigate through these difficult times, identifying opportunities in a world that is changing really fast today. And in these times, a growing topic of interest and debate has been the SDG, or Sustainable Development Goals, and their role in investing. Given that we have been getting a lot of questions on this topic, we decided to hold a series of webinars on this. We just had one last month around how do you invest using an SDG lens. Today, we're going to talk about, how do you track the performance of investments that you've made using an SDG lens. Just before we introduce our esteemed panelists, I just wanted to give you a brief about IvyCap Ventures. This VC fund was founded in 2011 with a vision to leverage the global IIT alumni ecosystem to foster entrepreneurship in India and to identify and invest in high potential entrepreneurs whom we felt, were heading towards being market leaders. And in 2015, we launched IvyCamp, which was India's first innovation and entrepreneurship platform that leverages the alumni network to help grow, create value for, and work with early stage entrepreneurs. And over the years, we've created a network of domain entrepreneurs that we regularly work with. And we conduct engagements with them, run a number of corporate innovation programs. And today I'm really excited to introduce our esteemed panelists who will talk about a number of topics around, how do you really track how your investments are doing? Because being a VC fund, obviously we invest in high potential investments, but we also want to look at those entrepreneurs that are, looking and keeping in mind, what some of their SDG goals are. So very excited to kind of hear about, their points of view. Just a couple of points on logistics. Hi, Starlene. We just got started. I'm glad you could join.
Really,
thank you for joining.
Issue.
No worries, no worries.
Thanks for having me, Anju. It's really great to be here.
Thank you so much. Just a couple of points on logistics. The discussion itself will be about 35 to 40 minutes. And then we'd like to open it up to questions with the audience. If you have any questions, please submit them through the chat with your name and we will raise them with the panelists. I just realized I forgot to introduce myself. I am Anju Gupta. I head up IvyCamp, which as I mentioned is a part of IvyCap Ventures. And I'm very happy to introduce our moderator, Smita Mishra, who is the founder of Fandoro, which is an organization very committed to SDG goals and that works with businesses to be planet positive. Smita, over to you to introduce our panelists and to get the discussion started.
Thank you so much, Anju. Thank you for organizing this webinar and for giving all the support required to put this together. Hello, everyone. Myself, Smita Mishra. I'm the founder and CEO of Fandoro Technologies. We are a platform that empowers enterprises to be planet positive by helping them identify and manage their sustainability related goals, their risks and opportunities using the SDG framework. We also support our clients with bespoke consulting services and offer remote sustainability team support in case they have limited or no teams to work directly and dedicatedly on their sustainability roadmap. As Anju already mentioned, this is the second webinar in the series for discussions on sustainability. Our topic for the last webinar was investment through SDG Lens, and we were joined on the panel by Padmaja Ruparel from Indian Angel Network, Shubhadeep Sanyal from Omnivore, and Ashish Wadhwani from IvyCap Ventures. And with the backdrop of SDGs detailing, some of the things we had really discussed in the last one was the value in non-financial returns, who were their typical signaling investors who showed interest in SDGs and why this whole movement has started, and the trend they saw with respect to sustainability being factored in, or maybe not, in the investment process. So we discussed at length if the panelists personally saw value in this, and why is then still there a huge gap in adoption and awareness amongst mainstream investors on sustainability. We are taking the discussion forward with our webinar today. As you all know, that the theme is tracking performance of investments made using the SDG lens. Now, we all keep seeing updates all around, nationally, internationally, globally, that companies and investors are being asked to support the 17 Sustainable Development Goals, the target year being 2030, where we have to actually meet quite a few of them. Some of them have actually described SDG as the closest thing the planet has to a strategy. Now, companies are using various diverse kind of frameworks, GRI, SASB, IIRC, SDGs. Now, we are a recent merger of two of the largest reporting frameworks coming together, and they are reporting on value reporting framework. But how are the investors measuring if their investments are making a positive or negative contribution to the financial, environmental, and societal social systems that support human life and, in general, life on Earth? It is obvious that certain shocks like the financial crisis or the steady and persistent degradations like the climate change and gender inequality or wealth inequality in these systems will make it impossible for investors to earn the returns expected by all of us. So I'll probably, with that as the background, let's just start the discussion with our esteemed panelists today. So we are joined today by Prema Jaiswal from Caspian Investments, and Starlin Johnson Sharma from ACT Grants, and excuse me, and the Green Earth, and Marcus Lemon from IvyCap Capital. So welcome, Prema, Starlin, and Marcus. It's a great pleasure to have you all here. And maybe we can start with a quick round of introduction from you about yourself and your investment thesis of respective teams. Maybe we can start with the ladies, Prema.
Thank you. Thanks, Kata. Before I delve into myself, just wanted to give a brief about Caspian Impact Investments. The fund was started in 2013 and is a registered NBFC in the country. And it is supported by DFIs across the globe. And also many impact funds have helped us create this platform. And some of those funders include OPIC, CDC, Tridos, FMO, Indian SIDBI. It's managed by people who are passionate about creating and supporting positive planet solutions, as you say. And our mission is mostly to support enterprises who, through business solutions, are able to create this positive impact, both in social or environmental space. There are certain defined sectors that we think that we have knowledge about, and that is why we fund those particular sectors like food and agri, health care, clean energy, technologies which enable improvement and affordable housing, financial institutions. And at CII, we funded about 150 plus clients till date, over 2,000 crores of debt funding to these 150 odd companies. Coming to myself, I have around 14 years of experience in creating and managing financial portfolios. And having a bent towards technology, I try to design solutions which are light and replicable. And have been mostly involved in branchless banking and in also being part of, I've been able to take some of those organizations to digital transformations, Caspian being one of them. So that would be me. Thank you.
Thank you, Prema. It's a pleasure to have you, and nice to, it's really good to hear about Caspian too. Maybe we'll come back to the detailed investment thesis in short.
Sure.
Yes, Starling, can we have a quick introduction?
Certainly. Green Earth is a climate innovation and investment fund. We manage funds for high net worth individuals and corporates. We're also the fund manager for Act Environment, which is a group of venture capitalists and leading entrepreneurs who came together initially to respond to COVID. Now we're taking on bigger topics or other topics, I should say, including the environment. And Green Artha manages the ACT Environment Fund. In addition to capital deployment, we really look at how our investments can support growth and commercialization of organizations, as well as support the larger climate innovation ecosystem so that more organizations are able to succeed. And we do this across the portfolios that we work with. And you know, in terms of myself, I have a history as an investor, as an entrepreneur, and I set up India's first climate and clean tech innovation fund that was recognized by the government of India. Now, in addition to managing Green Artha, I am the climate editor for Business India Publications and the founder of the Clean Tech Women's Innovation Network. So that sort of sums everything up, I think.
It's a lot of talent in the same person. Yes, welcome, Starling. Pleasure to have you. Marcus, would you kindly introduce yourself?
Yes, good morning, good evening to all of you. It's so good afternoon, such a pleasure to be here. Such esteemed panelists and a great forum to be engaged with, so much appreciated. Navigational Capital is, the focus of Navigational Capital is to allocate resources into sustainable projects of infrastructure and agricultural capacity worldwide. We do have a limited factor, is that we work with advisors around the world, and we work with private equity funds from mainly from Northern European, Scandinavian-based areas to allocate these funds into specific segments in specifically renewable energy at this moment. We have worked with agriculture and a number of other infrastructure developments, but our focus is on, at this moment, to implement and engage to maximize the potential of the capital in the renewable energy segment. Now, Navigational Capital we try to take a holistic approach towards our investment thesis. We engage what's called our capital compass. So it's not just about the making of returns on our capital. It is about engaging in all specific different types of capital concepts. So we look at physical capital, how the capital is engaged, where it is implemented, and what effects it has on the environment and the physical aspects of the nature. We look at the social capital and how it affects people, how we are going to be engaging these resources, and how the results of this will be affected on people. Then there's also cognitive capital. If it is actually going to do any good and improve the cognizance capacity of the people who are engaged in this. And we have executive capital, how it is implemented. So there's governance aspects and all types of diligence on corruption, as we do work in developing countries or developing markets as well. And of course, I think I want to bring out an item here before talking a little bit about myself in this introduction. Is when I came to the investment scope quite late, only a few years ago. And when I was doing my master's at Georgetown University, it came apparent to me that the focus of economics has been askewed. So I took it quite personally that there is no value given to the intangibles, especially, for example, a mother bearing a child and nourishing and creating that environment. That is an incredibly valuable capital asset to society, but it is not measured, it is not given any value whatsoever. So it is very important that we understand the holistic concept of how life is, how investments affect and are impacting all life in and of itself. So myself, I'm very engaged in the holistic approach, and having had the fortune to be in India a number of times, I've taken upon some of the holistic approaches, and I'm very interested to hear from Starleen and Prema about the approaches that you have as well.
Thank you, Marcus. We are all looking forward to hear from all of you. So if I may quote the findings of the investment integration project done in collaboration with the Investor Responsibility Research Institute, the Center Institute, sometime back, maybe a couple of years back. It said that around 10% of involvement by the world's largest investors, recognition about and legitimacy for considering system level issues will get the attention of all necessary stakeholders. At 1/3 threshold, a cultural change will start to change in the financial community, creating positive spillover effects on corporations, government bodies, and the NGOs. But it will really take 2/3 of the world's largest investors of all types, whether it is pension funds, sovereign wealth funds, endowment funds, financial services companies, mutual funds, and all activist hedge funds, all of them, wealth management firms, across all asset classes, the private and public and private equity, fixed income, real estate, and any other alternatives and infrastructure, all of them, before a positive system level benefits can be achieved in terms of, through these investors and in terms of achieving these sustainable goals. So with that in perspective, Prema, I would really like to hear from you first. What is your investment thesis? And maybe you could also highlight your due diligence process in terms of, are you considering sustainability as a factor when you do invest in a company? And how do you really, and we're talking before investment, because in the next round of questions, we'll talk about after investments, how we measure. But right now, before investments, what is your process?
Sure. So Smita, I think, first of all, I wanted to break this myth that impact investment is not something which is done with grants, or it's just, it's a social work. It comes with equivalent returns, capital returns, as any other fund house would be. But the better part of that it comes with double returns, and or triple sometimes. It is supposed to work with both, or rather all three: people, planet, and for profit. Okay, right. And keeping this in line, at Caspian, one of the most important part, as you rightly pointed out, was that at due diligence level itself, when our investment managers seek business partnerships, we would like to call them a business partnership with the entrepreneur, is that they are just doing the regular work what a traditional banking system would have done, of understanding the financial and operational performance of that organization. But beyond this, for Caspian, the saving starts also with the line of business of that we plan to provide our debt to, or get into an engagement or relationship with. We have a very strong due diligence process, where at the time of this exercise, when it is performing, right now it has become virtual, but earlier when we used to be on fields with those entrepreneurs and looking at their business line, we used to spend time while understanding their business, understanding their governance model, and also understanding their other partners or vendors that they were interacting with. A simple example of a supply chain, if we are there to support the supply chain or fund a supply chain organization, somebody who's involved in that, we also try to look at that in their other vendors who are associated with this partnership. Is there any case of child labor involved? And in our questionnaire, it gets equally marked out. These kind of representations and data and questions are brought and sought at the time of the virtual or physical due diligence that happens. We have an impact intake form that all our investment and managers are asked to fill, basis which we understand the business model and its implication, both social or environmental, or governance, when we make loan to that organization. And I would rather like to say that the monitoring begins here. Our monitoring begins much ahead of time during the due diligence itself, rather than making it a factor later on. We also follow an exclusion list where we call out what we will not service and what we will not support as part of our due diligence. And of course, we continue to look at both financial and operational matrices because, as I mentioned, we're looking for people, planet, and profit.
So is this exclusion list created by your own team, or is it something that is globally, or there are negative lists around?
So there is a global negative list already available, and because of, as I mentioned, that we are also funded by impact funds across the globe. So there is a standard exclusion list that is available, and we like to pursue and follow that.
Sure. Thanks, Prema. We'll come back to you again on the monitoring side of it. And just let me come to Starlin then. So Starlin, first of all, huge applause for all the work that SDG Grants has done. Of course, I know you keep saying that there's a huge army of volunteers behind it. It's not just one or two people, but huge applause for all of you. Very quickly, we had this discussion, and what I understand is Green Earth is it's looking for profit businesses to invest in. And with that in background, how do you adopt sustainability, specifically if it is about SDGs? I know we had this discussion on not focusing on one SDGs and them being interconnected, but whether if you are servicing more SDGs, or how are you really looking at investments? What's your investment thesis? And when you're doing due diligence, is any of the sustainability factor, SDG or not, factored into your due diligence process?
Yes. So to start off with, our thesis is 100% around climate and environment first. We fundamentally believe that if we do not fix climate and environment, all of the other good social work being done will be for nothing, because the planet will not be habitable, and there will be far more issues that come up over time as the planet deteriorates. So we first and foremost look at climate and environment. We look at social goods and social benefits as being something that we look for and want, but it's secondary. But one of the things that we really look at is the SDGs are not these simple 17 high-level items. Each of them has multiple different sub-clauses. And so when you're looking at climate and environment broadly, nearly every single SDG has alignment with climate and environment, whether you're looking at livelihoods and creating sustainable livelihoods, whether you're looking at agriculture and food security and the importance of that being done in a way that is planet friendly so that it is actually sustainable over time, whether you're looking at education, creating educational environments that are planet friendly, because then the kids can learn in an environment that is good in a planet that will sustain them over time. And so we really look at the SDGs across our portfolio, but first and foremost from the perspective of climate and environment. When we think about the types of organizations we invest in, and with ACT, we can also invest or give grants to NGOs, but within ACT and within our other portfolios, we can give grants or equity or zero return debt for ACT into for-profit entities as well. And with that, we really look at finding models that can be scaled or replicated in a way that they're going to create an outsized climate impact. We don't expect everything to be scalable. We expect some of it to work only at the small scale that is relevant to, but where it could potentially be contextualized to other markets. And throughout all of the work that we do, whether at Green Artha or for ACT, we create what we call playbooks, where we keep track and monitor what are the factors that influence what happens positively or negatively within particular aspects of a business, with the idea of over time being able to say, this is what works here, this is what doesn't work here, but if you move to a slightly different environment, this is, you know, it will work here. In terms of our due diligence process, we follow a relatively standard due diligence process, of course, with it being heavily weighted towards climate and environment. Two things that we do in our due diligence process that I think are sometimes a little unique is, in every due diligence, we look at what is the types of support that are going to be needed to help the organization make it to the next level. And that really can be, do they need connections into business? Do they need support with their financial models? Do they need to think through what is a better go-to-market strategy, or how to tie a business model to a go-to-market strategy so it's viable for customers to adopt given the customer's financial and economic situation? And we develop plans as part of our due diligence process and part of our investment process so that we know what we're going to be either providing directly or providing through our various partners to help the organization succeed. And then the second thing we put into our due diligence process is, what are the metrics we're going to be measuring? And for that, you know, we can get into it more when we're talking about what it is we're doing, but we really look at things that are very tangible, observable, and measurable. So I'll leave it at that.
Very interesting, Starling. Very interesting. In fact, I hope that the audience took note of what she said in the terms of being replicable rather than scalable all the time. So that is a very important point with, from sustainable businesses perspective, because not every business could be scalable. But yes, if I think if you want to work with Starling, then your model has to be replicable and maybe a success elsewhere too. Great inputs, great insights, Starling. Thank you. So Marcus, coming to you, I remember that in your introduction, you mentioned that you are a focused fund on renewable energy. But do you want to elaborate more on your investment thesis and on your due diligence process too, as to how you invest in any business?
Certainly. Thank you. And incredibly interesting theses to learn from here as well. Navigatio started 4 years ago and began to implement its capital compass thesis based upon these holistic approaches. I had worked personally with the Sovereign Wealth Fund, Danish Sovereign Wealth Fund, IFU, and the Sovereign Wealth Fund, I was advising for them, and the Sovereign Wealth Fund actually began in the 1970s from a principle to assist in the development of sustainable investments in emerging markets. A quick side note, it actually began when the Danish government found out that they were unable to import Brazilian coffee on a equitable basis, and they wished to assist these coffee distillers or makers in the Brazilian market. And then they said that instead of just purchasing from third parties, we want to make an impact on the capital, on the purchasing power that we have, and be able to assist in the development, the sustainable development of these coffee plantations. And that's how it basically began. And it sprouted from there and is now applying itself in Africa, in Southeast Asia, and throughout Latin America. And I took those principles quite at heart. I took those to heart, and I started looking at the thesis that was tied very much into the Sustainable Development Goals, but on a Danish sort of scope. The Danish scope is somewhat unique in that, being such a small country, everything has to be sustainable. There's no question about ESG does not exist in the investment thesis, because it is already inbred, it is already accepted from the outset that if it is not good for the environment, if it is not good for the social benefits, if it does not have governance, and then there's no reason to engage in such an investment policy, because there's no value to it. So I took those very much to heart and opened up Navigator Capital and began to engage with private equity funds that had a vision towards improving the environmental aspects. Now, then I saw the greatest transition, which is at our disposal, which is the energy transition. And I saw the impacts that are being made at the level of not only the micro level, but at the macro level of countrywide transitions. And when I left Brazil in 2017, I implemented that here in Canada. And I am at this moment in Alberta, Canada, which produces 98% of oil and gas from the Canadian states total. So we are producing over almost 3 million barrels of oil a day in this province, and the economy is focused only on oil and gas. I took it upon myself to say, well, we need to diversify this economic resource base, and we need to provide an opportunity for new development of new energy. So there was, as the levelized cost of energy has been decreasing, of course, for renewable energy, we find it incredibly attractive to look at investments in this area. And we have a resource also in this region, which is incredibly rich of wind and sun. So I took it upon myself to engage with private equity funds and bring them into the market. And we are actually, it will be announced today globally, the largest renewable energy power plant in Canadian history will be begun construction today with its 465 megawatt solar power plant. And it's over $500 million of investment that will be shot into the oil and gas economy. So we are transitioning the economy as it exists, and these scopes and this thesis I am beginning to implement in other economies such as Brazil and also into different areas in the United States as the transition becomes more and more robust. So that is our thesis, is to provide transitional impact capital into markets which are needing a diversification in that sense.
So do you only, so most of the investments that you make, are they large organizations? Do you work with smaller startups?
We have been focused on large private equity funds that are infrastructure based. But we are diversifying into smaller micro generation and distributed generation as well. And we'll be taking upon more and more sort of responsibility in the ag business development as well.
Right. Now, coming back to you, Prema, again. One of the things that I noticed specifically with your model and with Starlent's model was very peculiarly, you were defining your metrics on how you want to measure your investee firms on sustainability or any such metrics. You defined it much in advance. You didn't do it after the invest. Of course, you can add to it, but you defined your metric system in advance, and then you went ahead and started to monitor. So can you elaborate this more in terms of what are typical metrics? Maybe you could also share an example of your investments and take us through the journey of how you invested, and then what were the metrics and how you monitored the whole progress.
Sure. Thanks, Smita. So it's actually it's quite an interesting journey, because these matrices are something which keep changing uh, with time. And as we're aware that the whole impact investors globally have spent years to standardize these impact matrices and measurements. Of course, the outcome is Iris and Gears, to name a few. And with the onset of SDGs, what happened was that it also complemented the whole lens, and it defined a more easily understood language around impact for the world, and also helped us to standardize these matrices. So at Caspian, we use a combination of both of this today. And as Starlene was putting across, that each SDG has its own corresponding layers of indicators underneath, and it is not just the 17 line items. At Caspian, what we have done is we have taken the sectors that we work with. There are certain sectors that we've identified as our forte, and we work only for those sectors like food and agri, and others, as I mentioned earlier. All this information is also available on our website. But when we were devising this matrix for ourselves, we looked at each SDG and these indicators, and then we created a tabular matrix for ourselves, or mapping what can we measure. It becomes very important for us to start looking at it, what is measurable and what is non-measurable. Some of these are intangibles, as Marcus was saying some point back, where we also have, as an impact investor, while we cannot calculate the direct effect in numbers, but it is important for us to write down those information that is available, or the kind of help it is creating for the organization that we are funding. Of course, I would like to take an example of a company that we had funded, and it was called Gram Vani, and which means the voice of village. And originally, a very interesting business model. Originally, when they started out, they were trying to build a low-cost community radio services, and they were trying to do this pan India. And however, as we are aware that the community radio ecosystem is pretty expensive with respect to capex and with respect to maintenance also. So this organization went ahead and remodeled its business, and they created a automated IVR platform, which would try to mimic this equivalent of a community radio services, and they were able to host this infrastructure on cloud, which made it more scalable and straightforward and manageable. And because of this change in business model, they were able to cater to a lot of different corporates, government agencies, non-governmental agencies, social enterprises, and they were able to create this media channel, which then could be used by the set of institutions to pass on their messages to the local community. So when we started working with them, we understood their business model, and Caspian's forte is to structure the product as a debt that we offer to them. So for this particular case, we gave them a project-backed credit line, where the release of payment and the collection, both of them were in line with the project milestone that they were undertaking. And along with this, we did not just list them into a livelihood section and ask them certain straitjacket questions or t-shirt questions, but at a monitoring level, we started looking at what are the count of unique users that they were having, who called them, and out of them, how many of them belong to tier Y or tier Z cities in the country. And also we were looking at how many of them were of these customers that they were servicing, how many of them came from low income background. And of course, when we were looking at what kind of other services, who was coming and taking their services, what were the message and content that was associated with this, and with that we were trying to see what is the impact that they have created. This was a very peculiar case of a not straight fit into a SDG platform, but if I could take this in terms of local livelihood that they were generating, the amount of information, digital information that they were being able to create for this set of their users, and all of this through a unique solution that was available, community radio. I think as an example, of course, we have more such examples and unique solutions that we, fund today. But the idea was to structure the project and accordingly, pay them and both collect along with this thing.
Absolutely. And thank you, Prema, for highlighting that. One of the reasons I love SDGs is that on the 17 goals, 169 targets, 232 indicators that they have currently, and it is only growing. Of course, not everything can be quantified in all kinds of situations, but a lot of them, maybe we can also build the story around it and understand the positive and negative impact in those spaces. So coming to you, Starlene, on this is to understand, you also probably said that we have a very stringent due diligence. We want to really see how what are the models that we are interested in and how can we help them grow and take them to the next level. At any point, and since you did mention that you have focused on a specific SDGs, but there are primary impacts, then there are secondary impacts, indirect impacts on across various social values also. How do you monitor whether with whatever set of whatever was your investment thesis, whatever was your intent when you did invest in a particular business, how do you really track the progress of that or the performance of that particular investment? And do you use SDGs when tracking them?
So I would say, like, when we move beyond the investment, we determine what are the SDGs that we're going to be working against at the time of our due diligence and investment memos. Based on that, we determine which are the, between the business and the SDGs that we're looking at, we determine what are going to be the metrics that we're going to be monitoring. And we really, as I said before, look for those to be very tangible, observable, measurable. So we do try to make those as much as possible, business type metrics. Luckily for us, climate and environment, I think, lends itself to that perhaps more easily than some of the social impacts. But one thing I would say, and I was quite lucky, like back when I was at NYU, I actually, for grad school, I helped write a textbook on corporate social responsibility and socially responsible investing that's still being used at NYU Stern today. And that was really back at the time when double and triple bottom line accounting were first getting popular. It was when funds were first starting, there were those first 2-3 nascent funds that were looking at what is socially responsible investing. So I've always really approached it from the idea that, when we think about impact and we think about finance, it's really sort of like you can get any amount of impact and for your investment, but it's really about almost looking at it like, with finance, we can decide to finance anything at a price given the risk, right? And similarly, you can do the same with impact. You can always measure an environmental return on investment. It'll vary based on, what you're willing to look at almost as your interest rate, if you will. We think some businesses are much more aligned to it naturally. And others, you're going to have a cost to adopting climate or environmental objectives. And, so from that perspective, we think that the environmental impact very much mirrors the larger economy. and you need all different types of financial structures. And that is why it's important to have access to grants. It's important to have access to equity. It's important to think about the role of debt and how many organizations that are working on climate and environment are going to need all of these different things, just as you would see in the main economy or the regular non-environmental economy, because really everything is part of climate environment and vice versa. So we really, as I said, look for these tangible measures. What are the CO2 or CO2 equivalents that are going to be offset? How many liters of water are going to be cleaned or processed or saved? What is going to be the content of air quality, right? Because there's what goes out into the environment and leads to warming, but there's also the air quality that we're breathing and the impacts that has. And they're very highly correlated, but inevitably, they are two separate measures. Similarly, within water, you can look at what is the quality of water after it's been processed or not, or before it's processed. So we look at these types of measures in terms of, so quantity, quality. Similarly with land, you can look at soil and changes in soil quality, soil moisture content, and because that really gets into whether or not carbon can be stored, right? We work with a group that is able to help us determine this at very micro levels using technology. And we also really look at what is the impact created over time. So very much like you would think of time value of money, we look at climate impact over time. Right. So if we go and we're working on an afforestation or reforestation project, we know that for the first 5 years, the environmental impact isn't going to be high. Generally, trees don't start and bushes don't start having the highest amount of carbon offset until they're about 7 to 10 years old, at which point, it starts to stabilize. And so we really look at that as a measure over time. And then when it comes to choosing between different projects, we say based on the amount of impact we're expecting or based on the amount of capital we want to deploy, we're going to get more impact here or there, right? And so with each of the portfolios we operate, we really set up sort of standardized, on one hand, customized, and on the other side, standardized parameters for which we're going to be determining which investments are going to fit. So some of our investors, ACT, for example, is much more focused on being catalytic and making impact. And so we look at the catalytic piece as part of the due diligence process. We do have certain measures that we use internally for that also, but we use those as sort of the parameters for whether we're doing our job well as opposed to the companies. But we put money into companies that are going to have that sort of catalytic effect. But with the companies, we're really measuring sort of their outputs. So one of the organizations that we've worked with recently is a company that takes waste, and in this case, we're funding them for agricultural waste management. They've created specialized bioenzymes and biocompounds that will dramatically increase the value that is created from that waste, while at the same time decreasing the processing time, right? And so we have very clear and standard measures that we can use from that. How much energy is coming out? How much waste is going in? What is the economic value of that? Because then we're able to utilize that, or the organization is able to utilize that to then increase the amount of feedstock coming in for the purpose of biogasification. Because they're able to make more biogas from it, they're able to sell, they have more consistent revenues. It's a higher quality methane. And so they're also able to pay the farmer slightly more for the same amount of feedstock. So the economics work better. And so we look at it across these different parameters, but we get regular reports in terms of how much gas is created, how much feedstock is taken, what are the economics that are given to the farmers, what are the economics coming out of the firm. And we did that with the idea that that one is going to be very catalytic in terms of increasing the amount of waste that is no longer burnt. And we're looking at the models and mechanisms for scaling that up.
Thank you, Sterling. That was quite a few metrics, and thanks for sharing them. Very quickly, Marcus, since we only have 7 more minutes to go, and we have to pick at least 1 or 2 more questions. So I'll quickly request you, if you have a way to monitor, how you monitor the progress of your investments, if you could quickly highlight in a minute or 2 at max.
Great, thank you, Smita. And like I take the quote of Socrates. There's one thing I know is that I know nothing. So it's definitely a learning forum for me here to learn from Prima that one point I've taken is the exclusion list, and I think that's a very, very foundational and structural point for investing, impact investing, is to become more exclusive and to separate or filter the investments which do not fit within the portfolio, within the concept and the scope of the objectives. And then from Starlene here, the metrics are incredible. And we spoke of this, Smita, during our introductory conversation, is that it is difficult to have a taxonomy that is universal. One of in the environmental aspects, one of the aspects, of course, is carbon sequestration, or the avoidance of carbon emissions. And in renewable energy, which is our specialty, that becomes very clear and evident. But that does not necessarily include the social, cultural, or governance aspects. And these metrics and measurements are not easily transferable onto a universal scope. So I think it's a work in progress, as we discussed, and I believe that these metrics should be something that we discuss more on a universal platform. Try to create these taxonomy aspects, but of course, as Starlene also mentioned, we cannot translate them always from geographic region to geographic region. They have to be implemented on a micro specific aspect. So with ourselves, we are focused on environment, on the carbon emission reduction, but we are also very, very focused on creation of value in job creation and social impact. And that we have measurements on, and that we are very focused on measuring how to do that. One aspect, I know the time is very scant, but one aspect I think that we could look also into is the happiness index, how it makes people feel as well, because that is a great importance. If we cover all the bases of financial returns, environmental benefits, social aspects, but we also have to make investments feel good, and that makes that provides a stimulus and an impetus for people to do even more better.
Absolutely. Thank you, Marcus. Thank you, all the panelists. We do have a couple of questions, and I'm going to reach to them. But yes, the conclusion does here come to me that it's not a global taxonomy. It's not a global set of metrics that you can use, or they're not even standard metrics that you can use for each project. When you're measuring through SDGs, what I have learned so far is that you could probably use a common set of metrics more from the program governance perspective. But when it comes to the specific program and a specific region and a specific objective and intent with which you are investing, I think most of the investors are going to have their own custom set of metrics which they would like to apply. Yes, there are the IRIS-GEN systems of sectoral metrics that you can refer to, the SDG Compass indicators you can use, but it will be very specific to the investor. Coming to the question now, because I would love to talk more, but here is a question from Neha Mishra. She says, how can we leverage sustainable finance accounting models to implement double and triple bottom line for startups with a cause? Anyone who would like to go for it? Starlin, Prema, Marcus?
To that, I don't have a solution as such, but I believe that we can perhaps provide on the investment portfolio. We can perhaps provide even there's always the carrot and the stick type of aspect where we have exclusions such as Prima mentions, but we can also provide incentives where companies or assets or projects that provide these incremental incremental benefits, they can have a point system, just as we have basis points on financial. We can have a basis points increment on these investments to establish them as more valuable as an investment project. So all things being equal, if a project financial return is 100 and the other project is 100, but it has an incremental social benefit, then it will win out because it has an aggregate that the other project does not have.
Right.
That's the key reason I think impact investors like us exist, to help support these organizations who are able to help them sustain, and a model should not be run down just because it's performing in the sustain in the for the social or we are
Probably losing your voice, Prema.
Okay.
Yes, you're audible now.
Adding to Marcus, I just wanted to say that I think that is one of the reasons why impact investors in terms of debt and or equity exists today, to support these solutions, which are planet positive, as you say, and help them sustain. And we are these ecosystem intermediaries right now, who will support such solutions and help them pass this double or triple matrices that is possible today. We have a sector agenda that does exclusively this and does not support a regular business per se. There are funds which do this.
So thank you, Prema. We are absolutely out of time, so I'm going to take one last question where you could just answer very, very quickly in 30 seconds, and we're going to close out then. So there is Amit Gupta who says, and for everybody else who has sent their questions, I see Mukesh and Lakshmi and quite a few of them sending questions. Please don't worry, we'll respond to you one-on-one. We'll reach out to you and send you responses. So the final question for today here is from Amit, who says, what is the typical cost for debt for the impact firms? Is that something you can answer on the fly?
I could go and attempt that. I think, Amit, it is a very, the factor and the number ranges actually. At Caspian, we look at a professionally managed organization. What is the governance structure? Whether the business is asset light, even if there is no collateral to offer, what kind of venture backed firm, if it is at all. And apart from this, we're also looking at whether it is already operating in this high impact sector, as we call it, and whether they are innovating new funds or they're bringing some technological solutions. There is a study which shows by IIC, it shows that this rate ranges anywhere from up to 20-22%. Also, it goes up to that, depending upon at which juncture the funding is required and what is the funding purposes. But I think a CAGR of 14% exists today. But I would like to add it with the caveat that there is a lot of other things that go into, when we choose the rate.
Fair enough. That's a very fair and still helpful response. Thank you so much, Prema. Thank you everyone who's joined us today, and thank you so much panelists. I thoroughly enjoyed my discussion and I'm really looking forward to more. Over to you, Anju.
No, thank you everybody. I think it was a really interesting topic. It's been coming up a lot. There's this constant pull between, can you really make investments in companies that are financially viable, you know, given that we are looking at it from a venture capital fund angle, and at the same time, companies that do take an SDG lens. And, you know, we're talking to more and more people, and you are also kind of, you know, supporting the fact that that is possible. So great to hear there's so many people looking at this. There are a lot of entrepreneurs out there that are looking at this, and I think there's a lot of support that's growing for that. I'd like to also say thank you to all the attendees. We're going to have a number of sessions SDG related. Would love to hear from you if you'd like us to focus on a specific topic. I'd like to thank all the attendees again for taking the time to be with us and share your thoughts. And Smita, thank you for moderating. Thank you, everybody.
Thank you.
Have a great evening.
Thank you.
And day, Marcus. Thank you all. Bye.
Thank you. Bye.